This week on TickerWatch, we're looking at Microsoft, a tech giant in the middle of a strategic overhaul. The company just saw a major leadership change in its Xbox division after nearly 4 decades. At the same time, its stock has fallen more than 17% this year, even after reporting the largest earnings beat in its history. Why are investors selling off shares while the company doubles down on a multi-billion-dollar AI spending spree? We'll unpack the developments that are reshaping one of the world's most valuable companies. Welcome to TickerWatch News for Microsoft for the week ending February 21st, 2026. This week, we're examining the major headlines and market moves for Microsoft as it navigates a massive spending cycle and a significant leadership transition in its gaming unit. It was a difficult week for Microsoft shareholders. The stock has continued its slide, hovering near a 10-month low after 4 straight months of declines. Year-to-date, shares are down roughly 18%. This performance lags the broader market, with the S&P 500 remaining relatively flat over the same period. The sell-off has come with an increase in trading volume, suggesting significant repositioning among investors. The key takeaway is that despite record financial performance, the market is showing clear anxiety about the cost of the company's future growth plans. The biggest corporate news this week was a leadership shakeup in Microsoft's gaming division. Phil Spencer, the head of Xbox, is retiring after a 38-year career at the company, 12 of which were spent leading the gaming unit. He oversaw major acquisitions like Activision Blizzard and the growth of the Xbox subscription service. Taking his place is Asha Sharma, an executive who previously led product development for AI models and services at Microsoft. In the announcement, Sharma stated the company will recommit to our core Xbox fans and players, signaling a renewed focus on its console business. The other dominant story is Microsoft's immense spending on artificial intelligence. The company is pursuing what its AI chief calls true self-sufficiency, aiming to build its own powerful AI models to reduce its long-term reliance on partner OpenAI. This strategy comes with a hefty price tag. The company's capital expenditures climbed to nearly $30 billion in the last quarter alone. This is part of a broader industry trend, with some reports estimating that spending on AI from major tech firms could approach $700 billion this year. This spending strategy is expanding globally. Microsoft announced it's on pace to invest $50 billion by 2030 to expand AI infrastructure and skills in developing nations across the global south. Finally, the relationship with OpenAI continues to evolve. A revised agreement ensures Microsoft will receive 20% of OpenAI's revenue through 2032, an extension of the previous deal. However, OpenAI now has more flexibility to work with other cloud providers. This comes as OpenAI is reportedly in the process of raising more than $100 billion from a range of investors, including Amazon and NVIDIA, creating a complex dynamic where Microsoft is both a crucial partner and a potential competitor. Wall Street's reaction to Microsoft's strategy has been deeply divided. On one hand, several analyst firms downgraded the stock or lowered their price targets in recent weeks. Stifel and Melius Research both expressed concerns, citing potential Azure supply constraints and the view that earnings estimates for 2027 may be too optimistic given the high capital expenditures. On the other hand, firms like Citi and Goldman Sachs are holding firm with buy ratings, pointing to the long-term potential of AI offerings like Copilot. Overall, the analyst consensus remains a strong buy, with an average price target suggesting nearly 50% upside from current levels. This highlights a significant disconnect between the stock's recent performance and Wall Street's long-term outlook. Sentiment among institutional investors is also mixed. Regulatory filings show that some large funds like Tiger Global trimmed their positions in the fourth quarter. However, a Microsoft director, John W. Stanton, recently purchased nearly $2 million worth of shares. Adding another layer, analysts at Morgan Stanley recently labeled the stock the most under-owned megacap, suggesting many large funds are not fully invested. From a technical standpoint, the stock is showing signs of being oversold after its sharp decline. The share price is near lows not seen in about 10 months, and the Relative Strength Index, a momentum indicator, recently suggested that the selling might be overextended. Fundamentally, the story is a tale of two metrics: record profits versus record spending. The company's last earnings report was a significant beat, with revenue climbing 17% to over $81 billion, driven by 39% growth in the Azure cloud division. Yet the market is focused squarely on the cost of that growth. The nearly $30 billion in capital expenditures in a single quarter has investors questioning if the returns from AI will justify the immense upfront investment. While the stock's valuation of around 24 times forward earnings is higher than the sector average, it's actually below Microsoft's own historical levels, suggesting the price has compressed relative to its earning power. Looking ahead, the most significant catalyst for Microsoft and the entire AI sector will be NVIDIA's earnings report, scheduled for February 25th. NVIDIA's results, and more importantly, its guidance, will serve as a critical barometer for AI infrastructure demand. A strong report could help validate the massive spending from Microsoft and its peers. A weak report could intensify the current investor anxiety. Key price levels for Microsoft to watch include the recent 10-month lows. A break below this level could signal further downside, while holding it could provide a base for a potential recovery. The bull case scenario is that NVIDIA's report reinforces the AI growth story, and Microsoft begins to show clearer monetization from its Copilot services, easing spending concerns. The bear case is that the AI demand narrative weakens, and focus remains on the high cost of investment, pushing the stock lower. For now, the most likely path is continued volatility as the market waits for more concrete data on the return on these historic AI investments. Thank you for tuning in to TickerWatch. This podcast is for informational and educational purposes only and does not constitute financial advice. Be sure to subscribe to stay updated on the companies shaping the market. We'll be back next week with another deep dive.